by delaying it, you're able to have a larger down payment and therefore being able to pay it back and not be in a massive loan or a mortgage for the next 30 years because you wanted the dream home so soon, and now your after tax dollars is the only thing paying down that debt.
Financial independence.
Freedom.
Financial picture.
Independent financially.
Financial future.
Financial freedom and wealth.
Financial independence.
Get your fill. Financial independence and long life. Hello, and welcome to another episode of Get Your Fill, Financial Independence and Long Life. What better goals could you have? So today, cool people always come on to help us try to meet those two goals. And today, the person who I have on is really cool. His name is Victor Lagos, and Victor is a distinguished mortgage broker. He's a seasoned property investor with over a decade of financial acumen. Commencing his career at age 19, Victor's expertise lies within residential and commercial property finance, SMSF property finance, and diverse business loans. And he is also the host of Debt to Financial Freedom podcast. So he's perfect. Victor, thank you so much for being with us today.
No worries, Christine. Thanks for having me. Excited to be here.
Me too. And it's way early where you are, right?
It's not that early. It's like 7:14 in the morning. So thanks for making it this time. And sometimes I've done like podcasts at like 5 a.m. So this is much better.
Well, it's 4 in the afternoon here. So 4:14 in the afternoon here. So it's still well within my working day too. So it's good. Worked out perfectly. Yeah. So Victor, we have similar backgrounds. We're both we both have that debt to financial freedom mindset, and we both use real estate to create that ability to have some financial security and financial passive income coming in, or practically passive income coming in. And I guess the first thing I want to ask you is, because a lot of people who do financial planning and financial literacy and that, like anything in the financial realm, they don't like real estate. And I guess it's because they feel like they don't make, they don't get there, whatever, on the real estate. But I love talking to people who feel like real estate is a really good, valid part of a financial plan. And I just want you to talk about, do you feel like you're a little bit of a going against the grain to some other people that you meet, or is everybody like that you hang out with on board with real estate and loving it? And do you ever have like those arguments? They'll say, well, real estate, I don't want to be fixing toilets at 2:00 in the morning.
Yeah, it's a good question. So, they always say that in America, it's, the great American dream to own your own home. But in Australia, I believe it's actually more ingrained to own property in Australia. It's something that's been, and it's not just your home. It's actually more rentals or investment properties. And I think it's a lot to do with the rules and regulations that are basically saying that property is not a financial product. And that's also why financial advisors, financial planners don't advise on property, because they legally can't. And they also can't get paid for it. Right. But at the same time, they are probably property owners themselves. So some of them try to help as much as they can without risking their licenses, and without, trying to do too much predictions and forecasts around the property, but just more high level. Myself, I've never been on that side of the financial industry. I've always been on the lending side, debt. That's why my podcast is called Debt to Financial Freedom. So
using debt to get to financial freedom, right? Not
correct,
going from being in debt to being financially free.
Yeah. Exactly right. It's a combination, because people typically start at a young age in debt without any financial literacy education. And I've heard in the US, they can even get you while you're in college, and you can get credit cards without having an actual working income, but just government benefits, which is crazy.
Exactly. Without having any really means of paying them back, particularly. But sure, you can get a credit card, no problem.
Yeah, that's right. Which is, I got a credit card when I was 18, but I was working at least. So I had to figure it out myself. And then as I started working within financial services, I started to understand more and more on the inside, lending policies, why do banks and institutions lend money? And obviously, it's all profit driven, and it's
Right.
all on the basis of compounding interest. And to a bank or a lender, the borrower is an asset, right? They are income generating, but for the borrower, it's a liability because it's a cost for the money going out. So
Right.
it's flipped. But by having property in the mix that's income generating, it sort of evens the playing field a little bit. All right, it gives the borrower the ability to flip the debt into an actual asset
Right.
because now it's linked to something that's generating income. And usually, like we talk about passive income, well, that income then needs to cover the liability, which is the mortgage. So the bank's happy because their asset is making money for them. And then
Right.
the investor is happy because the rental income is paying for that
Right.
and some and then some.
Hopefully,
So
yeah,
therefore
exactly. Plus,
it's profitable.
hopefully, plus some for them.
Correct. Yeah. So I love having these types of conversations with people because sometimes it's perspective. Because sometimes people are like, "Oh, I don't want to get a lot of debt. I don't want to be, paying interest. I don't like the annual percentage rate or the interest rate."
Right.
And then it's like, but if it's making you money and it's other people's money and you're using leverage, like, hello,
Right.
why not?
Exactly. Where's the downside?
Yeah, correct.
You brought up a great point when we first started talking about in the States, that is the American dream is buy your house, but that's your house, right? Buy yourself a house. Is it so? I have my own opinions, but I want to hear like your perspective. Do you feel like it makes sense for a person to be renting where they live and then to be spending the money that they would have spent to buy their own house to actually have an investment generating vehicle?
Yeah, it's a good question because that's exactly what my wife and I did to buy this property that I'm currently in. This is my home office. And in Australia, we have a term for it. It's actually called rent vesting. So a rent vester is exactly that. Rent where you can afford. Rent where you'd like to live and buy where you can afford.
Yeah.
And because you get tax benefits by investing in real estate in Australia. So while you may not get all the incentives as a first time buyer, you can still benefit because one, you've got more capacity to borrow, especially if you're living with roommates or in a shared type arrangement. So your rent expense is low, and
Yeah.
then you go and borrow to purchase an investment property. Then you can focus in on an area that's actually more likely to grow because there's what's called a property clock. So everything is cyclical and
Hmm.
different states go up and go down at different times. So
Right.
by being able to time the market and not being emotionally attached to where you invest, you can actually multiply your capital, your actual investment in a very
Right.
short amount of time because you're being strategic. But when people try to buy the home, it's more of an emotional buy. They're not really looking. They want the numbers too, because everybody wants the best of both worlds. No one wants to
Right.
buy in an area that goes backwards
Right.
or loses value. But you're never going to get the best of both worlds. You have to focus in one or the other. It's like because when you're buying to live in, it is a liability. As much as it may grow, it's not earning you income. Even if you rent out rooms or have like a second, they call it a granny flat, which is like a small dwelling in the back.
Yeah.
It's still not optimal, and it still affects your lifestyle when you've got someone living there, right?
Yeah.
So the dream of being in your own home sometimes has to be delayed because by delaying it, you're able to have a larger down payment and therefore being able to pay it back and not be in a massive loan or a mortgage for the next 30 years because you wanted the dream home so soon, and now your after tax dollars is the only thing paying down that debt.
Right.
But by investing in by buying property as an investment first while you're renting, it allows you to then sell down one or two of those properties in the future and use those gains as your down payment. And sometimes I've had clients who have literally paid off their mortgages during their working career. Like, they're already in their 30s. And because they've invested in property first while renting or living with their parents, they're mortgage free. Whereas every other people who got into the mortgage to for their home up front are paying a lot of interest, and they're subject to all the interest rate changes that keep happening. So the cost pressures keep adding up, and they may then have regrets of like, why did we buy this place? It's too expensive, and then they may, unfortunately, sometimes they have to sell it because they can't afford it anymore. So then their dream is squashed, and then they have to sometimes move back in with family, or
Mhm.
downsize significantly, or go to an area that they don't actually want to raise their kids. And yeah, it can
Right.
be quite challenging.
Yeah, and I think that a lot of people do think, "Oh, I'll have to get my own living situation sorted first, so I'm gonna go buy myself a house, and then I'll try to save some more money for another down payment and then buy an investment property," which, yeah, it's backwards, but it's not. I don't know that it's, at least here, I don't know that it's really intuitive for people to think, I better get my investment first. They think, oh, I'm throwing away this money on rent. I could be, renting someplace that I could be paying myself rent. And like, yeah, but then are you going to, exactly, am I going to be living where I want to be living? Am I going to be living the life I want to be living? So,
I think the problem as well is people don't have enough information up front to make
yeah,
better informed decisions, because the whole system is designed so people keep borrowing more money. And and as a mortgage broker, we provide information around the loan to help the customer
yeah,
make a decision. But that's just the loan. The loan is linked to a property, and the property has outgoing costs, right?
right,
Holding costs. And therefore, what I believe people need to see, either from the professional that's helping them or themselves take initiative, is to create some cash flow calculations and say, and compare the two, right? Literally say, how much is it going to cost out of pocket when you count the mortgage and you count all the maintenance and insurances, and then also put in some what's called stress testing. So just if the interest rate was to increase, in Australia we don't have 20-year fixed rates. We have like maximum 5 years. So everyone is on a floating rate more often than not. And
yeah,
that can create problems because it's hard to foresee what's going to come.
right,
So people see the repayment as it is today, and then all of a sudden it jumps. And in the last 2 years, it's the interest rate has tripled. So it's unaffordable for a lot of people now. That was
right,
very affordable 2 years ago. Um, so if you then calculate, say, if I was to make repayments to buy my own home, and not pay rent anymore, this is how much
right,
it's going to cost me, and these are some of the variables. Alternatively, if I was to continue where I'm living or rent somewhere where the cost is probably a little bit more predictable, and there's less because you're locked into a lease or a tenancy agreement, and there's probably less maintenance too, because things that
right.
repairs
Someone
and
else
things
is
like
doing
that
it.
have to be paid. Yeah, someone else, the landlord has to pay for it, right? The owner. And then also work out, if I was to invest and put that into a property that's earning rental income, how much is that actually going to cost me? Is it positive cash flow, or is it negative, or is it neutral? And if it's negative, what are the um, chances based on today's numbers? And also, this gets a little bit more into data and understanding past trends in certain areas that are, what the average rate of growth is. If you put in the average rate of growth, and maybe you're conservative and drop that a little bit, um, and just use today's rental income, don't worry about increases. Uh, then figure out which one am I better off out of pocket, and then let's just say 5 years from now, or 3 years, 5 years, you know, best case, worst case scenario, which is the one that's going to put me in a better financial position. Compare the two, and then make an informed decision off of that. So I'm in the process of actually building something like that, so that I can offer that to my clients, and then
Great.
also offer that to other mortgage brokers so they can help their customers to make better informed decisions, because it's missing in the market right now.
Yeah, absolutely true. And there aren't, I mean, that's a conversation that I try to have with clients who are thinking of getting started, but some people are just they don't ever actually wanna have investment income or, they don't actually wanna have, their own property for investment property and stuff like that, so it doesn't always work out, but I like to try to kind of feel people out and see if they think that that's something they'd like to do and if they would consider doing it first. Um, but I know a lot of young people now, they're living with parents and they're just like, no, not an option to stay here. We gotta go.
Yeah. Yeah, yeah. I get that too. Like as I said, when my wife and I, we were renting in Sydney, Australia, and we were paying 700 Australian dollars per week in rent.
Yeah,
And that was relatively, I wouldn't call it cheap, but it was decent considering the location we were in.
yeah.
And that was an apartment. But then the rent started going up all around us, and more than likely it was going to increase to around 850, possibly even 900.
Wow.
And
Big jump.
and that's a lot of money no matter what. Like that's after tax as well, right? So you have to, and non-deductible, so that's not you're not getting any tax benefit to pay that. It's just to live.
Yeah.
And we had bought a property here in Tasmania, which is in the south. It's a small island in Australia, which was actually much more affordable to purchase when we bought it in 2021. And we had tenants paying the rent, and that was pretty much enough to cover the mortgage because we had a fixed rate. But then we thought about it and we started analyzing what's a better decision moving forward, to either keep it as an investment and keep renting and allow the rent to increase, or literally shift and make a sea change and move into the property that was an investment and turn it into our home.
Yep.
Uh, and that's what we decided to do. And it's been a bit over a year ago. So I think that's the cool thing here. And I don't know if it's the same in the US, is that you can start it as a rental, but you can convert it into a home in the future if it fits your goals and your lifestyle and you can make it work. It's so that's what happened for us. And now, we get a home that has a big backyard, that's got big rooms, and the mortgage is more affordable. Granted that it was on a fixed rate, so it was cheaper. Now that it's gone to floating, it's actually more than what we were paying in rent. But now, because I've been able to operate my business remotely and grow it, we can afford to pay it, and hopefully in the near future we'll be able to afford to pay it off faster. So, yeah.
So do you think so I'm of many minds about paying off your mortgage because that's that equity you could be working that could be working for you, right? You could do something with that. You could buy another investment property with that money. Yes, you're living cheaper, but you're not getting. I mean, here you get tax benefits for the interest. You get tax benefits. If you use some of that equity in your primary residence to purchase an investment property, that's really putting that money to work in a different way rather than just having no mortgage payment. I don't know. What are your thoughts about that?
So the way that it works here is it's what's called debt recycling.
Hmm.
So essentially, if you pay off your home, you don't have a mortgage repayment that's linked to the home as a principal place of residence.
Right.
But you can access that same money that you paid off and reborrow it and use it to an investment. So essentially, it's like you said, the equity. So
Yeah.
you're essentially generating equity by paying it off and then using that equity to invest. So while you're borrowing money again against the home and taking out a mortgage, it's not directly related to the actual property you're living in. Now it's related and directed towards an investment property, and therefore that interest is tax deductible once again. And you can essentially borrow 100% now with no down payment. You take out the equity for the down payment, and then you borrow the rest against the actual investment property. So therefore, it's actually a better position to be in because now your money's working for you, and the equity is not just sitting there dormant, doing nothing, saying, "Oh,
Right.
I've paid
Right.
off my house." Like, so it's great.
Yeah.
You don't have the expense. That's a great thing, but is it working for you? Are you
Right.
earning money from it?
So can you do that like halfway along where you've got still some money, your house is worth more than what you have as a loan, and you can take some of that, recycle it into another income property before you finish paying it off?
Yeah, definitely. We do that. That's probably one of the things that I do a lot for customers. They want to invest into commercial property, or they want to invest, into another residential property, and they're still carrying a mortgage on their home. But
Mhm.
because the property has increased in value, sometimes significantly, they're sitting on a whole bunch of equity.
Right.
So what we do is we split the loan. So we have the main loan, which is their home, principal and interest, and then we split it and we access, say, up to 80% total. So let's just look at round numbers. If the property is worth $1 million and they owe, say, 600,000, that's 60% LVR, loan to value ratio.
Mhm.
But in order to extract equity, they can go up to 80%, and therefore they've got up to 800,000 total lending. So now they've got 200,000 of accessible equity, which they can cash out. The bank will let them release that as cash, and
Mhm.
they can then use that as a down payment to purchase another property.
Excellent. Is that what you're planning to do with yours?
Not in an immediate rush because the property unfortunately hasn't continued to grow. Fortunately, as well, because I am someone who is, pretty hungry to grow. So if it does grow, then I'll be trying to find a way to access the money and keep going. So, so really, at the moment, it doesn't have as much equity to tap into. It did initially, and just to let you know, part of the story is that it grew the first 12 months over 100,000. We were able to access that equity again immediately, and we bought another property in another state in South Australia,
Mhm.
in Adelaide, and then with essentially no money down. Right, the money was
Right.
coming from the equity,
Right.
and everything was going along quite well. It was an up and coming area, and then interest rates started to creep up. So then it became I guess, a bit of a cash flow drainer. So so then we just thought, okay, it's costing us money now. It's no longer passive income. Now it's negative cash flow.
Yeah.
So we need to figure out, is it the right time to sell or should we hang on to it? And this is sometimes the things that investors have to do, is make a decision for the family, because financial freedom is a feeling more than anything else, and the
Right.
more freer you feel, the better you're going to perform in your business, in your job, in your career. And then so that's where, because I own my own business and it's in the sort of that growth stage, I needed to feel freer. And if it was draining cash flow from the business, not
Right.
allowing me to invest, it made sense to sell it. So instead of keeping it long term, we sold it after 12 months of owning it, a bit more than 12 months. And because it was well researched and timed, we timed the market quite well. It grew $150,000 in value in that time.
Nice.
So we were able to use that money to pay off, of course, the original mortgage, the equity, and a couple of other loans that we had taken out because of the move and whatnot.
Mhm.
So it actually helped free us up significantly in terms of our outgoing expenses. So while I don't recommend that anybody enter into property investing for the short term, still have a long term outlook and view, you want to make sure that if things don't work out and you need to get out in the short term, you're still in front.
Yeah.
So that's what happened to us.
Well, so you talk about timing the market, and that's sort of a controversial thought with people, right? That you can know what's going to happen, you can get into the right neighborhood, or you can get into the right place at the right time in the cycle and things like that. And there is some ability to sort of do that, I think, especially if you have a long-term view. But what kind of information or tools do you use to feel comfortable that you're investing in the right place at the right time?
Yeah, it's a really good question, and to be honest, I try not to speculate at all, especially for my clients. So I never tell them where to invest and show them, because that's not my profession, and I don't want to take on that risk that I tell them and they say, "He told me to invest here and it
Right.
didn't work," because there's always going to be things outside of your control. Government policy, immigration, interest rates, COVID, whatever
Right.
it is, right?
Right.
You can't predict that. But the cool thing is, as technology is advancing and big data is being, I guess, uh, accessed and available and interpreted by companies, then you can actually find some of these data providers and use that to your advantage by making, I guess, these types of decisions and saying what's the I guess the up and coming area that's showing a trend, or essentially what it comes down to is supply and demand.
Hmm.
So by understanding the markets that have got a limited supply but an increased demand, then there's an opportunity there to catch that growth before it's public knowledge. Because the majority of people don't do this. Majority of people will go and do the inspections and go to auctions and buy an emotion, right? It's more driven by the owner occupied market than it is the investment, because the
Right.
only way property values will grow is if someone's willing to pay above the current market, right?
Right.
And the current market price is based on recent sales. If a similar property is sold for a certain price, that's the expected price that a buyer would say, I'm going to buy something similar.
Right.
But because of the increased demand, limited supply, and someone really having a desire to live in that particular property, they're usually going to pay above what everyone else is paid, and
Right.
force it upwards, right? And then others do the same, and it becomes this I guess a
This
compounding
glorious
thing, that
cycle.
the glorious cycle, correct. And so there's a company, one that I've been dealing with recently in Australia, and I'm sort of, um, I don't understand enough to tell you how their metrics work, but they're called HTAG, and it's called higher than average growth. Why I like them is that they're a pure SaaS company, so they look at the data unbiased. So they'll look at residential property sales data and listings data across the entire country for the last 30 years or so, right? So they can kind of look at, and they'll also look at future things as well, like government infrastructure projects, money that's being invested in certain areas and proximity to certain, things that are necessary, like educate, like schools,
Hmm.
transport, and things like that. So when they do that, they can look historically and say, okay, in the past 20 years or 30 years, these suburbs have had this many average days on market before properties have sold. This is um, how many listings there are, and therefore there's a certain amount that they can actually, make a data informed decision. If there's not enough sales in that area, it's very hard to sort of confidently say that's going to happen again in the future.
Right.
Um, and then based on your price point and the rental return you're looking at receiving, you can plug those numbers in, and then you can sort of shortlist the suburbs, and then it
Hmm.
has like a score, and that score is where you can say, okay, it's very high likelihood that this area is going to have higher than average growth based on these metrics, and then other areas will have a lower score for certain reasons. So that's the best way, is for customers to basically not hand over the keys to their financial future to someone else and say, here, tell me where to buy.
Right.
um, or listen to someone. They always say, your friend at a barbecue,
Yeah.
um, you know tells you the next area, the up and coming area, because that's where they invested.
Yeah. Right.
That's the speculation aspect, when.
Yeah. Well, by the time it gets to the barbecue, it's probably too late, right? That train's already sailed. Or the ship's already sailed. By the time it gets to the barbecue
Right.
level, it's too late. Same thing with
Mm.
stocks and stuff, right?
Correct. Yeah. And I know in America, you guys have buyer's agents. And in Australia, it's a relatively new industry,
Mhm,
but it is growing. But I'll be honest with you, like I did use a buyer's agent to purchase in not Tasmania, the one in South Australia,
mhm,
and they did most of the legwork and the research and negotiation. Um, but I don't actually agree with the model. I think it pulls power away from the individual to actually make better informed decisions, and therefore doesn't let them feel confident with what they did. Because at the end of the day, they're the ones taking on all the risk, right? If you're
right,
the investor, you're borrowing the money, you're taking on the mortgage for 30 years, you're dealing with all the the maintenance things when things break, you're replacing things, right? You're
right,
dealing with the tenants, and a lot of the time if you have a licensed professional like a property manager, you can remove that emotional connection. But sometimes people do end up self-managing, and then
right,
they have to deal with all the emotions of the tenant when they tell them that they've had a death in the family or they lost their job. And and it could be very emotionally draining when you say,
right,
okay, you don't have to pay rent for the next what
right,
month, but you got
exactly.
to pay your mortgage still, you got to pay the cost, so now you're paying for them, right, to
Exactly,
live. And then
right,
it's very hard to sort of then go back and be firm and say, look, you haven't paid it, time to go. It's, as a human being, it's never an easy conversation to have. So
right,
you
right,
want to distance yourself as much as you can. So I guess the reason I mentioned that is that if you then allow somebody else to charge you money, sometimes $20,000, sometimes more, and they put you in a property, they're not going to foresee a lot of this, right? You're the one that's committed to this on paper, at least for the next 30 years.
right.
They get their money and they're done, right? And they move on to the next client and they'll continue. So I think it's better that education is very important in this space. This is why podcasting is great.
Yeah,
Um, so that people can actually know what they're getting themselves into and be prepared for that potential roller coaster that they may may be going on. Uh, and is the potential gains worth the ride that they're sort of embarking on. So
yeah, absolutely true. So, Victor, I mean, our time is like flying by. So, I want to just ask you, is there anything that I didn't ask you that you really want to talk about, or something that you want to make sure that people take away from our conversation today?
Um, I'd say probably a lot has got to do with combination of knowledge and wisdom. And knowledge is obviously you can gain a lot of it, but wisdom will only come through the experience. And dealing with hypotheticals can only get you so far. But if you're actually living in it, you learn a lot more. You get life experience, you get the wisdom to actually know what not to do next time and how to help others who are on similar journeys.
Yeah, absolutely.
So I think it's important that no matter what, you don't get stuck in analysis paralysis or this what if you're stuck in what ifs. I think
Yeah,
you eventually you have to pull the trigger
yeah,
and move forward and get in on it. And I guess it's important to have a good support team around you
yeah,
that can guide you through the the different decisions that you might have to make along the way, whether it's your mortgage broker, whether it's your selling agent, your buyer's agent, your property manager, your accountant, your lawyer. So have a good team around you that you can ask questions to that will guide you, who
yeah.
have experience, and yeah, just move forward. I think it's important. Jump in, but don't just jump in without considering a whole bunch of stuff. Still jump in. I think it's the best way to learn through
Excellent.
experience.
That's great advice, Victor. I really like the way get your good team, get the knowledge all around you, and then just do it.
Yeah, exactly. That's right. Nothing will change.
Absolutely.
You can't expect it to change if you don't change, right? So,
Absolutely. Okay, awesome. So, Victor, we're going to put all the ways, if people want to reach you, we're going to put all your contact info into the show notes so they can check out your website, and, connect with you on social media. And also, maybe, are you okay if people want to ask you questions? And obviously, they have to hook into your podcast as well.
Yeah, of course. Yeah, you can find the podcast on YouTube, on Spotify, and yeah, there's a contact details. So if they want to reach out just for questions, not necessarily potential customers, happy to have a chat. The good thing about Australia is that if you wanted to invest in Australia and you were living in the US and had nothing to do with Australia, there are actually lenders based here that will lend money to you to buy property in Australia.
Awesome.
Granted, it can be more expensive, more taxes, and you need to get approval from the government. But if you invest well, you're still going to be in front. And of course, you make sure that you've got the income to support, you know. And so that's what my team can help you do to navigate the whole system. And if you're interested to learn more, reach out.
And the great thing about investing in Australia, if you're in the States, is it's a great excuse to have a vacation. You can say, oh, I'm going to stay there for at least a month to check out property, to do all the paperwork and all that good stuff. Yeah. It's a super. I mean, you got
Exactly.
to think about these things when you're buying your investment property. Is this a place I want to visit?
Oh, 100%. I think anytime you're buying somewhere else, you do want to go check it out. It's a pretty big thing where to buy something fully sight unseen and never going there, you need to make sure it's real.
Yeah,
And also if tenants move out and you're able to actually stay in the property for a month, that'll be great, right?
exactly,
So yeah, for
exactly.
sure.
Yeah, you're missing out on the whole idea of investing, in my opinion, if you don't go visit the property, hang out, try things out. It's a big giant tax write-off waiting to happen. So
Exactly, that's right. It's a holiday.
yeah,
Uh,
exactly.
that's a working holiday, basically, yeah. And if you can work
Exactly.
on your laptop, you can still do other things while you're away as well. So
Yeah,
you're not like
exactly. It's
fully on
perfect.
leave. Yeah. Yeah.
Awesome.
Great.
Thank you so much, Victor, for being with us. It was fun talking to you, and I appreciate you, meeting with us in the early hours, maybe even before you had your coffee.
Yeah, I had a quick one before this actually to wake me up. Great. It's really great to be on and lovely to meet you, Christine. And hope we can have a chat in the future. I'd like to learn a little bit more about, what you do and the market that you're in.
Thanks. Yeah, it's been a pleasure, chatting with you and stuff. And thank you, listeners, for listening. I know you've loved listening to Victor, even if it's just only for his cool accent. But he also shared lots of great information. So right now, think about at least 5 people you can share this episode with who are interested in real estate investing, who want to read and who want to hear and learn, and who might be interested in listening to Victor's podcast, which is cool. Debt to
Yeah.
Financial Freedom. Debt to Financial Freedom. Yes. And that's, yeah, right. Use debt, good debt. Think about Robert Kiyosaki. So for this episode of them, Victor will thank you, and I will thank you, and your friends will thank you too. And have a wonderful week. See you next week.